Good evening, everybody. Today we are going to discuss audit evidence chapter, which is in the auditing subject. We call it financial control and auditing, which is number 303. Now, this session has been organized by AAT Institute just because they have seen. So, in the marking papers continuously, students are not up to the standard to get the highest mark in this particular area. So, just to improve the situation and bring the improve the awareness among the student, AAT Institute has organized this event and invited me to give you an awareness about this audit evidence chapter, so that you can score or you can mark more in this upcoming exam. So before I get into this, so I should thanks to AAT Institute for organize this particular event and make it successful in your upcoming exam. And the meantime, so let me give you my agenda, how I am going to deliver this entire subject today. So our approach or agenda is, so let me summarize what is auditing first. So I will summarize it and then we can identify and we can figure it out. So where, in which area we are going to discuss it. So then you know what is auditing. So in my style, and then we can approach to our main objective of audit evidence chapter in your syllabus, right? So let's discuss. First of all, let me share my screen so that I can give a proper update on what's the auditing. Okay, hope you can see my screen. Now in here, if you look at this is the entire audit process. So this is going to be the entire audit process. Now in here, so one of the major area is, you can see one of the major area, you can see there are three phases. So one is audit risk assessment. The first one is audit risk assessment, and then you have another box saying audit risk response, and then you have the audit opinion. So in auditing, so we can basically divide into three categories. So one is audit risk assessment, and second one is risk response, and finally audit opinion. Now, when it comes to audit, so most of the work area, most of the time of the auditors will involve in this audit risk assessment phase. Now, if you look at basically now, if let's say for example, now you are invited to an audit of a particular entity, particular organization. But when before you go there, if you start the audit, you don't know what kind of a business is this, what kind of a environment is it, so what kind of a risk they have currently, and what kind of a risk they follow, and what kind of a strategies or actions they have taken to minimize the risk. And you have no idea about this business, and you don't know what the trends are in the industry. So it's all, let's say you start it newly, so it's a new audit plan. So this is the first time we are going to do an audit. So if that is the case, now you need to understand their business properly, right? So you need to understand their business properly, and then you need to know what kind of environment it's available. So what is the existence of their environment? So what are the challenges they face from the external environment, and what are the challenges they face from the internal environment? Those information need to be gathered. So basically, to understand the business and its environment, it's very, very important before you start the audit. So now, that is why we give priority to identify the audit risk. First of all, we need to identify the audit risk. So what is the audit risk? Audit risk is where now auditor faces this risk. So what is the risk? We call it risk of material misstatement. So there is the risk of material misstatement. Now let's say, for example, now if there are material misstatement in the financial statement, and if auditor gives an opinion to say that these financial statements are shows true and fair view, then auditor has to face an audit risk because he has given an incorrect audit opinion for this financial statement. So that is the risk that auditor faces here. So in order to minimize this risk, so what audit is going to do, auditor need to understand what kind of a level that this financial statement has in terms of risk of material mistake. So what kind of a level it has. So whether it's when you see the financial statement itself, you can you namely as there's a high risk. So we call it overall financial statement level risk. So in order to get a better understanding about this financial statement, whether it has material misstatement, so auditor need to understand everything. So need to go to the business and understand what the business is about and what's the environment involved and what is the organization structure, what is their ownership structure, what kind of operation they are doing right now, and what is the reporting framework. Do they follow Sri Lankan accounting standards or else they follow something else? So that need to be understand. And then what kind of control systems they have. So what are the control and the procedures they have? If the procedures and the controls are improper, then auditor can be happy because we can understand that something comes out of the proper system is in a good position and it's a reliable. So that need to be understand. And business always face risk. So what kind of a risk management strategies or the framework that they follow. So all these informations are very important to understand whether this particular entity, financial statement of this particular entity has higher ROMM or not, right? So auditor basically need to determine ROMM in two levels. So first level is overall financial statement level risk. So when it comes to overall financial statement level risk, with the proper risk assessment, end of the day, auditor can identify whether this particular entity's financial statements are considered as overall higher level risk. Or else you can say overall there is no risk. Overall, when you say there are no risk, and or else you can say there's a modified risk, moderate risk. So that overall level of risk you need to identify in this particular when it comes to the audit, right? When it comes to the audit, that's the priority. So that's the major thing you need to understand whether these financial statements are in overall there's a risk. So if that is the case, then that says everywhere in the financial statement you expect there could be more material mistakes everywhere. So that is called overall level of risk. When you see each and every items of the financial statement, everywhere there could be risk. There could be material mistakes. So that is because if particular organization doesn't have a proper internal control system, if organization doesn't have a qualified accountant, if organization doesn't have a proper processes and proper risk management framework, and the management of this particular organization is not honest, and you found that there are so many frauds happen in this particular organization. If that is the case, those are the indicators. When you see those indicators, so what you can decide is you can name this particular financial statement as overall level risk. So if that is the case, you need to respond to that in a different way, right? And if I am an auditor, so I don't like organization to have overall level risk because as an auditor, I have to perform so many tests to check every item of the financial statement whether those are misstated material, right? So as auditor, I would happy if the company has a proper internal control system, if company has proper procedures, and so that I can expect the organization, whatever the financial statement they prepare are in a proper, reliable manner. So if that is the case, I can be happy because I can do some kind of a smart auditing work and finalize the audit, right? So first of all, as auditor, you need to determine so whether this particular organization has an overall level risk. And after that, let's say for example, you conclude based on your risk assessment understanding, there is no overall level risk. But when it comes to property, plant and equipment, or when it comes to revenue area, you feel there is something is missing. So you can't ascertain, you can't determine the completeness of the revenue because they are preparing invoices manually. They are preparing invoices manually. So if that is the case, so there's a high risk because you can't determine your completeness of the revenue. Completeness of the revenue. Now, what do you mean by assertion? Assertion word itself looks like very different thing, but this is a very normal thing. Now, if you look at what is assertion, now whenever we start an audit, so organization gives us financial statement. So when you see the financial statement, revenue is 500 million. So when you say 500 million revenue, so it has so many hidden ideas. It includes kind of a hidden idea like this. Now, let's say for example, revenue is 500 million. So that says that is the entire revenue is 500 million. Completely revenue has been recorded, so the value is 500 million. So the completeness of the revenue is 500 million and the value of the revenue is 500 million. So value is correct. There is no other income categorized here. So classifications are correct. And the cutoff is correct. Let's say now you prepare this financial statement for 2024. So if that is the case, whatever the transactions happened in 2023 is not considered here. And whatever transaction happened to the year of 2025 are not considered here. So you have proper cutoff. So those are the indicators when you read that figure. But when you see the financial statement, it's just a figure, 500 million, but it has so many meanings of it. So that is completeness of the revenue, accuracy is correct, and classifications are correct, cutoff is correct, and these revenue items all of the revenue items are occurred. Because these are real sales, not the bogus or incorrect sales. These are real sales. These are real sales that are happened within the business, right? So those are the indicators we can see. So we call it assertion. So those are the assertions. So auditor is supposed to check those assertions and see whether completeness of the revenue is correct, accuracy of the revenue is correct, and whether these sales, all of the sales are they real, and the cutoff is correct, right? So those assertions need to be determined, whether those assertions need to be checked out by the auditor. So in order to do that, so auditor need to understand where could go wrong, right? So where could go wrong? So if not, auditor has to do so many things in their financials, right? So many stuff. And if you look at particular audit, now if you want to check 100% of the organization transactions, so that's not possible. So if that is the case, maybe one audit firm can do one particular audit for a year, right? So that's not possible. So we as auditor gives a reasonable assurance. So in order to give the reasonable assurance, we need to work smart, right? We need to work smartly. So we call it smart audit, or we say risk-based audit. So proper terminology would be to say risk-based audits. Now, that's why auditor is supposed to determine whether this financial statement has overall level risk, and whether this financial statement has where you can identify the assertion level risk. So based on that, let's say for example, when you conclude revenue completeness, it's very difficult to determine. If that is the case, auditor need to do more testing. So based on your risk assessment result, then only you have to decide your response to identify the audit risk and risk areas, and then you need to determine your work audit or gathering audit evidence. How we are going to do that? So you need to gather appropriate and sufficient audit evidence. So we can touch upon today. So that this is the area we are going to discuss more in detail. And then accordingly, you can determine what kind of audit procedure you need to perform, what is the nature of the audit procedure, and what is the timing of the audit procedure, and what is the extent you need to check, how many invoices you need to check. So those things need to be decided based on what? Based on risk assessment that you perform. So result of the risk assessment is very, very important, because when you identify properly the risk areas, so you can determine your work accordingly, and how you need to allocate your resources, and how you need to allocate your timing to cover these risk areas, right? That's why I told you this is a risk-based audit. Whenever there's a high risk, auditor need to perform more tests. Whenever there's a low risk, auditor need to perform very less number of work there, right? So what is audit risk? You can see in small table, small chart there here. You can see audit risk. What is the auditor? What kind of a risk that auditor face? Audit risk is if there are a risk of material misstatement. If there are risk of material misstatement, so we call it ROMM. So why there's a ROMM? Because there could be an error or a fraud, right? Error is something innocently people does it, right, without any intention. But if you look at fraud is something people do it with an intention, clear intention, right? So risk of material misstatement that happens because, so what is the component of, what is the result of risk of material misstatement? ROMM. So ROMM is a component of inherent risk and control risk, because there could be some situation where risk of material misstatement flow to the financial statement, right? So that is basically as a result of these two things. So one is inherent risk and the other one is control risk. So what is inherent risk? If you look at this particular item, inherently it has a risk. Naturally there is a risk. Let's say for example, stock, there is a risk. Revaluation, there is a risk. Related party transaction, inherently there are risks. And event after balance reporting period, yes, there's a high risk. Inherently, there is a risk of those items. Even you put so many controls, it's very difficult to mitigate that risk, right? So some of the items are having more risk than the others, because naturally those items has risk. So we call it inherent risk. And you might, now if you look at the organization, when there's a risk, they put proper control to avoid it, right? When there's a risk, they put a proper control. But there can be situation, even though company has so many controls, but there are few instances where control fail. If the control fail, then what happens? Then there's a risk of material misstatement included in the financial statement. So due to the nature of some of the items, So that is called inherent risk. So that will result some financial material misstatement of the financial statement. And then again, when there is a control risk, because you might have learned, even if you put so much control, but still controls can be failed because people implement this control, people plan this control. They tend to made some mistakes and collusions and so many things. Like so, because of that, there can be situation even though you put control, it fails. So as a result of that, there could be some material misstatement, including the financial statement. So ROMM is a result of these particular two components. As a result of the nature of this, some of the particular items, there could be some chances risk material misstatement would be included in the financial statement, right? And in the meantime, even though you put so much of control, still control can be failed. So if that is the case, that would result to include material misstatements in the financial statement. But still, now if auditor is smart enough, if he can detect that risk, then if he can detect that material misstatement, we can ask client to correct it, right? We can ask client to correct it. But auditor failed because if he couldn't find out these material misstatements, then there is a risk of incorrect audit opinion, right? So there's a risk of issuing an incorrect audit opinion. So that is called detection risk. So audit risk goes up because when there is a high risk of material misstatement, and if auditor fail to find out it, figure it out, detect it, so then audit risk goes up. That's how audit risk is happening, right? Now, hope you can understand what the audit risk is. That's the component of ROMM, and there are two components: internal risk and control risk. And even though there are so many material misstatement, if auditor is smart enough to find it out, detect it, then so we can reduce the audit risk. But if he fails, then there's a risk of giving an incorrect opinion. So the auditor will have to face a risk, right? Okay, now ROMM is the major thing. So doing entire work around this audit risk assessment area. So where he trying to figure it out, trying to find out which component has more risk, which component has less risk. And whether the entire company, entire financial statement. That's the first level of risk. And if you find out there's an overall level of risk, then auditor need to respond like this. So auditor will have to allocate more senior members to the financial audit, or he can ask for an additional partner to review this financial statement, and auditor can include more reviewing process in the audit and discuss frequently with the audit team, right? So this kind of a changes he can bring when he sees there's an overall level risk in the financial statement, right? And if there's an assumption level risk, let's say for example, revenue completeness is very difficult to determine. So if that is the case, then he need to start performing tests based on his judgment, whether he need to perform, he need to check invoices from the beginning, January and June and December, or else whether he need to check all throughout the year. So that need to be decided by the audit accordingly, based on the risk level that he identified in the assumption level, right? So now, end of the day, so based on his understanding about this risk of material misstatement available in the financial statement, So he start gathering appropriate and sufficient audit evidence, where he need to perform audit procedures, and he need to determine what kind of audit procedure he need to do, and what timing and NT we call it. He need to decide NTE of the audit procedure that he need to perform, right? And continuously when he does this process, there's a time where he satisfied with gathering all these appropriate and sufficient audit evidence. So if that is the case, now he is ready to make his opinion. Now it's time to make his opinion. So you can see there are mainly 4 types of opinion. So we call it unqualified opinion. So you can say even unmodified opinion. So opinion, of course, we can divide into 2. One is modified and the other one is unmodified. So unmodified opinion is, we can name it as unqualified opinion also, or we can say as clean opinion also. So that is basically auditor satisfied that there is no material misstatement in the financial statement right now. Even he would have found something, and he has informed to the client and he has corrected everything. So if that is the case, there is no material misstatement based on evidence that he gathered. So now he start giving an opinion to say that audited financial statements are give true and fair. That's the clean or a good opinion that he can give. So we call it unqualified opinion. You can see in the green color here, unqualified opinion. And the second opinion, we can say qualified opinion. So there are 3 modified opinion. Unmodified opinion is the unqualified opinion. So let's say, for example, you can categorize entire audit opinion as like this. Audit opinion. You can say unmodified audit opinion. Right? Unmodified audit opinion. Unmodified audit opinion. Right? Unmodified audit opinion. Other one is modified audit. Modified. Modified audit opinion. So under modified opinion, you can see there are 3 opinion. So one is qualified opinion, and adverse opinion, the last one, disclaimer. So here it says basically qualified unmodified opinion says it's true and fair view. Says true and fair view. Qualified opinion, they say, so other than inventory, so that particular item has risk, right? Only that particular item has material misstatements. So other than inventory, for example, saying here inventory. So other than inventory gives true and fair. Other than inventory gives true and fair. Adverse opinion. So auditor gives his opinion to say that and not true and fair. True and fair. And then last says, as auditor, they do not express their opinion. So these are the audit opinion that he can issue based on the different situation, right? So you can see here different type of auditors from the green to red. So unqualified opinion and qualified opinion and adverse opinion and disclaimer opinion, right? Okay, with that, now we are going to touch upon this particular area today. So which is audit evidence. Let me go into our area and then we can discuss more in detail, right? Me this first. So let's come to audit evidence, right? Audit evidence. Then write down audit evidence. So what is audit evidence? So audit evidence are the information. Any information here. So let me so audit evidence. So audit evidence we can define as, so whatever the information used to form the audit opinion is called audit evidence. Whatever the information. So whatever the information used to form or the give audit opinion are the audit evidences, right? Now under this chapter, so under chapter number 6, you can this is chapter number 6 in your syllabus. So we can let me write here. So under chapter number 6, so these are the topics that we need to discuss today. So one is so what is external confirmation? Second, analytical procedure. Analytical procedures. And third, so first one is external confirmation, and second one is analytical procedure, and third auditing sample, audit sampling. Fourth, right, audit sampling. And the fourth one is related parties. Related party. So audit sampling, related party. Or fifth one can say event after reporting period. Six, going concern and last, management written representation. Presentation. So those are the topics. So we need to discuss today, right? So let's start the first one. Before getting to this first one, so let me give you what kind of procedures we can perform to cover the audit evidences, right? So to cover audit evidences, so there are set of procedures we can perform. So we can these are the audit evidence. Yes. So one is we can remember this with this I Korea. So first one is inspection, inquiry, and confirmation. This is observation. This is the recomputation. This is re-performance. Inspection of documents and inspection of physical assets. Finally, analytical procedure. So these are the procedures auditor can perform to gather audit evidence. If you look at first one, the first one is inquiry. Now in the inquiry, so auditor can inquire anything from management, employees, or the lawyers, or he can inquire from previous auditor and top management, from the directors, from any person in the organization. So he can do an inquiry. So he can inquire. Basically, this is kind of a verbal discussion. But in order to make it formal, so what auditor need to do is we need to prepare for that discussion well in advance and make sure he raise questions based on a structured manner, not just a casual chat that he's going to do, but to gather kind of audit evidence, he need to plan and work accordingly and make sure he everything documented properly into a written documentation, right? So where he can inquire from different parties of the organization and gather some evidences. And second one is confirmation. So where he can call confirmation. Now we are going to discuss that particular subject here, confirmation. So I don't want to discuss it more in detail. So confirmation where auditor can gather more evidences, right? More to see the figures are correct. And let's say, for example, if he need to do an audit of trade receivable or trade payable or the cash balances, bank balances, investment balance, investment value, and whatever the stocks that are there in the third party locations. So we can ask for a confirmation from those parties, and we write a letter saying, so please inform to us, so what's the value in your books. So we can ask for a confirmation from the parties. So that serves the purpose, right? So if he confirms saying that the value is this, then you can compare it in your records, finance record. So if that is aligned, so if that is correct, telling, then you don't have a problem, right? So that is one confirmation. So we will discuss it later on. And the third one is observation. So auditor can observe some of the procedures so that are there, that is in the organization. So for example, auditor can observe the inventory count and how do they perform it, so that he can gather some of the evidence based on his observation. But observation itself has a kind of a very low level of reliability. Now, whenever somebody looking at you, so you do whatever duty that is ideally must do, right? So that is how it is, nature of the human. So observation doesn't give a very good, reliable audit evidence, but some of the occasion, yes, it gives a good observation. Good audit. You can consider it as an audit evidence procedure. And recomputation. Now, auditor can perform, he can compute and see. Let's say, for example, interest cost, he can compute and see whether it's correct with the organization. Or else he can do a depreciation calculation and see whether it's in line with the client organization. And whatever, he can compute it and see, compare with the accounting record of the client. So this is recomputation. And reperformance. Reperformance is where auditor perform it. Let's say, for example, bank reconciliation. Even though company has done it, so he can, auditor can decide he will do it. He will do a bank reconciliation himself for the December month and see whether it's agree with the organization, right? So he can perform bank reconciliation, debtor reconciliations. We call it creditor reconciliation. So he can perform and see whether these are in line with the whatever produced by the organization, client organization. And inspection of documents. So this is very vast area. So whatever the documents he can inspect and see whether these figures are in line with the whatever recorded financial statement. So these are inspection of documents. So that is basically we do a lot of things here. So basically to review the documents of the financial statement. Inspection of physical assets. Now to see whether stocks are available in the organization, so you need to go to the warehouse and see. So we need to inspect the physical assets, right? So to see whether there are motor vehicles, so you have to go to the location and see. But can you inspect the data? No. So you can't see the existence of the data by looking at the person, right? So but some of the assets, to see whether these are available in the financial statement, so available in the organization, you have to go to the location and see, physically verify whether it's available in the organization, right? So especially like to measure the existence of the some of the assets like building, vehicles, machineries, inventories. So if that is the case, you would have to go to the location and physically you can check whether those are physically available. So at the last, we have another one, analytical procedure. So again, we are going to discuss under this topic, analytical procedure. So we don't want to go into more details right now. Now, analytical procedure is where, so you are trying to confirm the figures or the amounts that are there in the financial statement by doing kind of a analysis. Now, by looking at the documents also, like you can confirm the figures. You can see whether these are correct. But by doing a procedures and analysis, you can confirm that. Right? For example, you can do a ratio analysis, you can do a variance analysis, you can do a sensitivity analysis, you can do a logic test, you can do an expectation, developing an expectation. So there are set of things you can do. You can prepare a graph and see the trend analysis. So those are the analyses you bring into the picture and see whether you can confirm the figures that those figures are free from misstatement. Right? Okay, now let's move to the first one, external confirmations. Let me explain it one by one. Let's take first one, external confirmation. Now, for example, in the audit, so we can see trade receivable balances, trade payable balances, right? So we can see trade receivable, trade payable, advances, or deposits, bank balances, right? So there are so many balances available in the financial statement. So investment, or else can say third party stocks. So stocks available at the third party's locations. So those balances, you can get it confirmed by a person or another organization by writing a letter. You write a letter to them saying, look here, we have a trade receivable balance as at this particular date. So please confirm whether you are agree with this balance. So you can get it confirmed from these parties. So by a letter, right? So if that is the case, that gives a good indication about the organization. The whatever the figures that is available in the financial statement, you can see whether this is correct. Right? Simply as that. So when you, for example, you write a letter to the bank, ask them to confirm the balances directly to them, audit. So when bank confirm the balance saying the bank balance of this particular current account is 500,000, and you can check whether the bank's balances available in the bank reconciliation is correct, right? So whenever trade pay data, one of the data confirm their balance, so you can compare with the balance in the financial statement. So if that is incorrect, correct, so agree with the balances. So then you can come to a conclusion saying this is correct. So there is no material misstatements available in that particular balance, right? So these are the particular scenarios where you can call confirmations. Now confirmations, external confirmations, we can classify into two. There are two kind of external confirmation. One is We call it positive confirmation. Right? So one is positive confirmation, other one is negative confirmation. Positive confirmations, we can classify this into two. One is you can ask them to confirm by mentioning the information. You can mention trade balance as at 31st March 2024. As per our record, trade balance of this XYZ Limited is this much, 500,000. Please confirm. You can mention the information with information. You write a letter to get it confirmed from these people of that particular organization, but you include the information as well. Even you can ask for information, you can ask for a confirmation without information. You openly write a letter saying, so we are auditor of this organization. Please confirm the balance available as at 31st March 2023. Or right. So we call it without information. You can write a letter and get it confirmed. Without information also you can do. And you can ask. Now in here he might confirm a figure, but we don't know whether it's correct or not. So best thing is to sending a thing with the information, because if that is the case, if the figures is different, so we can ask them to provide some justifications or the reasons for such difference as well. So we write a letter in here. As per our account, 31st March 2023, trade receivable balance shows 500,000. If you agree with this, please confirm. If you are not agree with this, please send us the reasons for such difference. So if that is the case, we get a good confirmation, reliable evidence from the third party to make sure that balance is correct, right? So negative confirmation is where we send a letter and asking for them to respond if balance is different. Let's say, for example, that particular debtor has a 500,000 balance in our financial, in this particular financial, client's financial. And when you write the letter, you say 500,000 is available at as at 31st March 2023. If this figure is different to your financial statement in your organization, please inform to us. If it's matched, then he doesn't need to inform to us. So that is a negative confirmation, because some of the occasion, even if they didn't receive the letter, so we might think there's no difference. That's why he has not replied to us. Right? Maybe client organization has written this letter to the wrong address also. But then again, we don't get a reply. Right? So in here it's negative. Why we call it negative confirmation? Because we call the confirmation saying, if you agree, we don't need to respond. But if you doesn't agree, then if you don't agree, then you need to respond to us saying what the differences are. So that is the case. So we don't mostly use this negative confirmation because it has some problem. Now we always go for with information, go for positive confirmation. So this is where auditor can easily get the confirmation from these parties, whether whatever the figures or the amounts available in the financial statements are correct. Easily can cross check with these letters. So we call it external confirmation, right? Hope you can understand that. And moving to the next topic. Moving to the next topic, we call it analytical procedure. The next one is analytical procedure. Next one is analytical procedure. So what is analytical procedure? So that is another test that auditor can do to make sure those figures are correct and to identify the risk areas also. He can do this test. So these are basically just to analyze the figures. So maybe with financial and non-financial information. So by mixing of this information, you can gather some evidence from some of the areas, right? So you can say what is analytical procedure is 520. You can say this is 520 auditing standard 520 auditing standard 520. Here external confirmation 505 auditing standard number 505. Auditing standard 505. Here 520, right? So what is the analytical procedure? So you can say what is analytical procedure? Analysis that are performed by the auditor using financial and non-financial information to figure it out to understand some relationship between these figures, right? So basically, these are the procedures that he can do under the analytical procedures. First one is he can perform a ratio analysis. You might know this, right? Ratio. He can perform a ratio analysis. And then he can identify whether is there anything unusual. Or he can confirm the figures as well. Ratio analysis, trend analysis. Can do a trend analysis and see whether there's something wrong. Third, he can do logical test. We call it logic test. Can do a logic test. Fourth, I haven't seen some auditors do this test. Fourth one is very, very important. But when I was doing auditing previously, I used to do this test all the time because that is very very easy to do and get the get it confirm the figures and see whether is there any unusual things. Easily we can analyze by using, we call it developing expectation. Developing, you can say, an acceptable expectation. Acceptable expectation. And compare with accounting record. And compare with accounting record. Compare with accounting record. So this is something that let me explain one by one. So, and you can do ratio analysis, trend analysis, logic test, even variance analysis also you can do. Variance. So this is more towards doing some analysis, right? So you are just trying to analyze the figures and identify some relationship between financial and non-financial information and try to confirm the figures whether it's true and fair or it's true and doesn't have any mistakes. For example, now you can say if you see the GP ratio, gross profit ratio, 2024 and 2023. Now, normally we expect any businesses to have the same GP ratio to be maintained all over the years, right? Now, if you look at the businesses, there could be some situation it's changed, but usually we expect organization to maintain their GP ratios. That is profit generating from their trading business. So JP ratio is, let's say for example, in this particular year, they had 40%, and now it's become 30%. So why it's very low? So you can see, you need to have more testing to see why this particular organization has very less GP ratio compared to the previous year. So that is basically you can identify easily from a ratio analysis, right? Ratio analysis. Now, let's say for example, trend analysis. Trend analysis, where draw a graph and see whether it's in line with the other information. For example, tourist arrival to Sri Lanka. So you put a graph, tourist arrival to Sri Lanka, so it increased like this. And if you if you are auditing a hotel, so if this trend goes up, then we expect revenue of this particular organization also to goes up, right? Then the revenue of this particular organization all over the years. Let's say for example 4 years, 1 year, second year, third and fourth. Then your revenue also should go up like in the same pattern, nearly same pattern. So that is called trend. We just compare with some other information to see whether this trend is correct. And for example, another example, we can say you can see how the raining fluctuates during the particular year. So you can get the data from the statistical department. How the rainfall like this among not years. You can say first month, second month, third month, fourth month, fifth month, 12. So this is how rain falls between the months of the year. So if that is the case, if you are doing an audit of a plantation company, so we expect the inventory also to be goes up like this, nearly like this. But if you see like your inventory goes up like this, then something wrong. Then there's something wrong because we expect the relationship between the rain and the inventory items, right? So these are the trend analysis. Like you do some graphs and trying to understand the trend between financial and non-financial information, right? So that is one of a test analysis you can do. You call it trend analysis. And third is logic test, where you can do a logic test. Logically, you do the calculation and see whether it's correct. Let's say, for example, we can take number of employees there. Let me take the number of employees. So you can take average salary of, let's say, for example, they have 1,000. So you can take average salary per person. Salary. What is the average salary? Let's say, for example, that is 8,500. So that's basic. So simply you can multiply and see in 2000 whether this year basic salary is like that, right? Basic salary is like that. So you can do a small logic test. Logically, you do a small calculation and see whether it's correct. So if that is correct, then you don't want to go into detail and check the documents thoroughly because you see logically it's correct. So we can conclude that there is no material mistake not include that particular salary item, salary expense. So either you can, let's say for example, you get a total basic salary of this particular organization. You can apply 12% of this. So that is EPA makes sense, right? You can apply 3% of the total basic salary of the entire year. That's logically it should match. If doesn't match it, then we have a problem. So logically it should match. So when you take the total basic salary into 3%, so it should match. So that is called logic test. You do a small logic test and see whether this amount available in that particular expense is correct. Right? So otherwise you might have to go into detail and see like whether this particular organization, what is the EPF each and every month they have paid. And you have to go each and every salary file. So that's a hectic thing, right? It's a painful thing because you have to refer so many documents. So why you can't do a small logic test and see whether this figure is correct? So that's what I said. Auditor need to be very smart. So auditor need to be smart, and he's the one who decide what need to be done, what kind of a timing we need to check, what extent he need to check. So that is all depend on the auditor. So if he's smart enough, then by doing these analytical procedures more, he can find out so many problems from the organization and even get it confirmed by by the figures and the amounts by doing an analysis ceiling. The meantime, he can recognize the unusual transaction asset, right? Fourth one, most importantly, as I said, because I got a name called expectation Mara. Because every time I'm trying to develop some expectation, so I can compare easily with the account record of the client. So developing an expectation in the auditing standard 520, so it's clearly explained. So what is developing expectation? Let's say, for example, now in this particular year, you have said, let's say now this particular organization sell black color defenders. It's a vehicle selling company, right? So let's say they had number of vehicles, same like the salary computation, number of vehicles. So in 2023, they have sold 100 quantities, 100. And here they have sold 150. Now, why don't you get a average? We have to find out. So you can get data from the client organization. So what is the revenue generated from selling number of defenders in 2023? And how many numbers they have sold? 100. So you can compute the average selling price of a defender in 2023. So the same thing you can apply here. Right? You can apply to 2024. Let's say, for example, the revenue they have recorded here 1,000 million rupees million. Right? If you divide by 1,000 by 100, so it's 10 million. So one defender they have sold as 10 million. So what you can say? So expected revenue. So you development revenue. Expected revenue is for 2024 is how much? Now you can calculate the average selling price is 10 million. 10 million is the average. You can say ASP, average selling price. So if you can apply into 100, average selling price is 10 million, rupees 10 million. So you can apply into 150 vehicles. So you can expect 1,500 million revenue in the 2024. Then when you compare this with account records, accounted sale. So it says 1,400. So as per you, it's like, so I expect 1,500, but now it's 1,400. So what's the difference? You can inquire from the management. What is the difference? So if you look at the 2023 average selling price of a defender is 10 million. So you have sold 1,150 vehicles. So why revenue shows 1,400? Why not 1,500. You can ask from the manager, right? Then they might come up with an answer saying, okay, now in this 2024, we have reduced the price by 5. So they have reduced the price. Okay. Then if that is the case, you can apply the same and see whether it's correct. Then you can see variance. Variance is due to what? Now I'm trying to figure it out. Justify the variance, right? So if they apply 5% out of this, 5%. So 10 million is the price. 5% is how much? 0.5, 0.5, right? 0.5. I don't know whether it's. So let's say 5, not 5%. Let's say 1%, 0.5%. Now the vehicle price has come down, so they have reduced the price by 0.5%. So if that is the case, you can apply and see now 5% into 10 million is how much? 1.5. 0.5 into 150, how much? So that is 75 million, right? 75. Out of which 75 you have justified. Now the difference has become quite low, right? So now in that way, you can justify these numbers easy, right? You can justify this number. Now, if you look at in the other way, if you are trying to do inspection of documents of the sales, you might have to, let's say for example, now there are 150 vehicles, you have to take entire 150 invoices and do a sample. So let's say for example, you put everything into a system, sampling system, or if we are going to touch upon that also, audit sampling. So when you upload everything into the sampling system, so computer provide you the sample. Let's say out of 150 vehicles, so they have asked you to check 50 sample. 50 sample. Now if that is the case, 50 invoices you need to check to confirm whether this revenue is correct. But by doing an small analysis, you can do the same thing, right? So when you justify with the variance, you can easily cover it. So even though, let's say for example, now even this particular organization, I just get a simple example to say that only defenders they are selling only defenders, but you can get the numbers of the other vehicles as well. If they are selling some other vehicles, so you can get the Outland. So those numbers you can take. You can go into that detail. You take the different models they said, and you take the number of quantities they have sold in 2023. You derive the average selling price of the vehicle, and then you can get the same number of vehicle they have sold in 2024. Just apply the rule. That's it. Then you can justify the figures, right? So when you see that it matches perfectly, you don't want to go into detail and check. So that's why its analytical procedure is very, very important. But very rarely we see people, the auditors, they use this particular area properly to cover the audit, right? And the various analysis. Various analysis where you just compare the numbers with the previous year and see whether is there any unusual things in their financials. For example, revenue, you can get revenue, each and every item you can get the 2024 how much, 2023 how much, what is the variance. We're just trying to understand. Under 50 million, 100 million, so it's increased by 50 million. So cost of sale. So it says 75 million. Now here it says 40. So its difference is 35. So we're just trying to understand why there's a difference. So is there any unusual transaction? Let's say, for example, now revenue has increased. You can see. But if you compare this particular figures with sales commission, here it's 2 million, but here it's 3 million. So why there's a reduction in the sales commission? Why there is an increase in the revenue? So those relationship you can see. So unusual relationship easily you can identify with the various elements. And if let's say for another example. So when the revenue goes up, so I am expecting data value also to goes up together with this, but it has come down. So is there a particular reason? So you can inquire from the management, right? So when the property plant equipment compared to the previous years goes up, then you can ask from the management. You can check whether depreciation has. If that is not the case, then you can inquire from the management. What's the reason? That's logically here. We can match these figures. Then property plant and equipment goes up. It has gone up. But depreciation has come down. So basically, they might have missed to depreciate some of the assets. Is that the reason? So that question should go straight in one. So that is one of the area. Then you need to check that, right? So these are the important aspect of analytical procedure. Basically, we try to get understanding and identify unusual areas or the risk areas, and in the meantime to get it confirm whether the figures are correct. So we perform this analytical procedure by using financial and non-financial information. So, right? This is a very, very important area where you get an overall understanding. So I would suggest as an auditor, when you do an audit somewhere in the future, so please use this analytical procedure thoroughly, more in detail, so we can identify, we can figure out so much material misstatement very easily, rather looking at each and every piece of documents, right? Okay, now the second topic is done, and the third, sampling. So where in here audit sampling is like, let's say for example, now whenever you need to go for a test of detail, right? So now let me put in this way. Before that, let me tell you. So these are the audit procedures auditor can perform. These are the tests auditor can perform. Audit response to the risk identified. So once the risk assessment is done, the risk identified. So whatever the risk areas that is identified already in the risk assessment, so you can do two things. So one is test of control. We can test the control and see whether whatever the identified controls are working properly. In the meantime, we can do substantive testing. We call it substantive testing. So in substantive testing, we can divide into two. One is test of detail. We call it TOD. Here we call it TOC, test of control. And substantive testing, we can say the other one is substantive analytical procedure. And that's called substantive analytical procedure. Now in here, so what I'm saying now, risk assessment is already done now. So we have already identified our ROMM level, whether there's an overall risk and what kind of areas have the association level risk. So we have already identified. Now we are just trying to respond to it. Now we have seen in the risk assessment area, right? Risk assessment area, the particular company has so much of good control. Let's say, for example, they prepare their bank reconciliation monthly. So when the month is completed, I mean, just after the 2 working days following the month, so they prepare the bank reconciliation and accountant or the financial manager, the person who is heading the finance department, who signed the bank reconciliation. I think that's a proper control. I call it Montessori Palana Krame. So Montessori control so that is to make sure all the transactions that are happened with the bank is recorded in our financial statement to make sure that we prepare the monthly bank reconciliation. That's a basic control. So if that happens, if that is the case, that is how they say, that's a good control, right? So if that is the case, when the month is completed within 2 working days, we make sure that all the transaction happened with the bank is recorded. So that's a good control. So month by one, when you complete the 12 months period, so entire financial year is completed. That's good. So if that is the case, if that is the controls that they have, then as auditor, you need to see whether that control is implementing. That is what they say, right? That is what they say. They say it like that when you do the inquiry stage. But you are supposed to test whether that particular controls are implemented properly. Then you have to take few of the sample of the bank reconciliation. So few months within the year and check whether they have done the bank reconciliation properly and whether the particular head of the department, finance department, has signed off the bank reconciliation. If that is the case, when you test that, yes, perfectly this has been happened. Then it's good. Their test is spot on. They are doing it correctly. So if that is the case, then whatever the substantive test. What do you mean substantive? Substantive means you are just trying to confirm the figures, right? You are just trying to confirm the figures by doing some other test. If the controls are good, then you can perform less number of substantive tests. Remember that you can't just do the TOC or the test of controls, and when the controls are proper, can you just disregard the substantive test and conclude audit? No. So auditing standard clearly say either you have to perform substantive test entirely, or you might have to go for a combined approach, control test plus some of the substantive testing. So you can't just do the POC and finish the audit. So either you can do, let's say for example, now this particular one of our organization, it doesn't have proper controls, then you can't test anything. No? You have already concluded saying they don't have proper control. If that is the case, you have to go for substantive testing entirely, right? And the second one, now they have a set of controls, those are properly implemented as well. But you can't entirely rely on test of that. You have to perform some of the substantive testing as well, right? So that's the combined approach. So when the combined approach comes in, so you might have to do test of detail. Or else you can do analytical procedures, what I have already discussed here. So you do the testing and logical test and developing an expectation, whatever the analytical process. So you can do and make sure those figures are free from materialistic, right? So in here, so in order to do this test of detail, right? In order to do this test of detail, now you can't check entire detail of the organization. So let's say, for example, you were supposed to check the sales. Now let's say test of control is failed. This particular organization doesn't have a proper control to recognize the sales. They do prepare invoices manual. They don't have serial numbers properly. So it's very poor. So if that is the case, we will have to go for the substantive testing now. Now, if that is the case, now when you go for analytical procedure, so you don't have much data to rely upon, right? You can't rely on the data what they have provided. So when you get the data also to do the analytical process, the data looks not so good. So then you can ignore that. You will have to ignore that, unfortunately. So if that is the case, now you get the sales invoices. When you see the sales invoices, you can see there are about 1,000 sales invoices this particular year. So this is called population. This is called population. So, but you can't check entire 1,000 invoices. What you can do, you have to select some of the invoices, few invoices. So there you use some audit sampling technique. So there are some computer-aided audit techniques also. Or else, if not, you can see like the values, higher values invoices. You can select, let's say you have selected much higher values, 100 invoices are there. Now you are supposed to check each and every invoices, whether this quantity and the price is correct, whether that sales value as per the invoice is recorded in the financial statement. And in the meantime, whether customers got these goods, when they submit the goods, they get an acknowledgement from the customer. And in the meantime, whether the customer has paid. So these particular details you have to check for all 100 invoices, right? So that is called test of detail. You have to go to the detail. That is a very hectic thing. It's very hectic thing, right? A difficult thing. But if you can justify the numbers with the substantive analytical procedure, then it's good. You don't need to go for the test of detail, right? So so this is what we are going to discuss right now. In test of detail, we'll talk about. Before that, we need to understand what the audit sampling is going to be, right? So how do you decide the audit sampling? So there are two audit sampling techniques. So we call it statistical sampling and non-statistical sampling. Into two. One is statistical sampling. The other one non-statistical sampling. So there are two kind of sampling methods. So where statistical sampling is where each and every item of the population. So what do you mean by population? Population is entire thing, entire invoices, entire list of invoices, or you can say entire list of debtors. Now you are trying to call confirmation from the debtors. What you can do? You can take entire list of debtors. Yeah, let's say for example, you have debtors about 450 debtors, right? You have 450 debtors. So this is population. Call it population. So out of this population, you are supposed to select a sample. So what you do now in the statistical sample, there are systems like CAT system. We call it computer-aided audit technique. So I remember that I used one of a CAT system called IDEA system. So what you can do, you can upload entire listing of data to this system, and systems gives you, and there are set of criteria you need to give to the system. So whenever you give that particular information to the system gives you an sample. Look here, these 20 data you need to test. Now, what we are trying to do here, now system says based on some criteria, there are 20 data you need to check. So we get that list and we call confirmation from this list. And whenever they confirm, let's say they have confirmed saying these figures are correct, data values are correct. So if that is the case, now you conclude like this. Now you have called confirmations from the data. They have confirmed this, everything is perfect. Now you come to a conclusion. All these tested sample is correct. Then you can conclude saying the entire population is correct. Right? So we can conclude saying entire population is correct. Right? You check on 20 noise, 20 data, and then you can come to the conclusion entire thing is correct. Now, let's say, for example, if some one of data has not responded to you, so then you need to do some additional testing. You can check whether this particular data has paid subsequently. They should have settled the value subsequently. So you can check subsequent month, see whether they have settled this month. So that is one of the tests. Additionally, you can do if you didn't get the third party confirmation, right? Now, in this particular scenario, we have uploaded everything, entire 450 name of the data and the value of the data with some criteria, whatever they wanted in the system. Now, in this sampling technique, if you look at, now they have each data has equal opportunity to select the sample, right? And we don't know what the data is, but when you give everything to the system just do something calculation. I don't know, it's a very technical thing. So, but system says when they filter this 20, so system gives them each data chance to be selected into the sample. If that is the case, that's a statistical sample. But if you select highest value of the data among these 450, you select another, let's say 15 name of the data. So if that is the case, you haven't given the equal opportunity to the each and every data to select into the sample, right? If that is the case, so that is called non-statistical sample, right? So we have not given for all items to the equal opportunity to select into the sample. In order to select into the sample, if we have not given any equal opportunity for them, then that is called non-statistical sample. So that is how we filtered it out before we get into the test of detail, right? So when you decide, you need to go for the test of detail. So if that is the case, you need to take the sample either by way of statistical sampling or non-statistical sampling. So either way, you need to select, right? So that is called sampling method, right? Now let's move to the other one. So related part. So what is related part? This is okay. So what does related party mean? So there's accounting standard also. I'm going to discuss in thoroughly what the related party is going is. But in simply, I would say, let's say for example, one of a particular organization called XYZ is a company. So there can be some parties or organizations above them who control this particular XYZ company. They control this or significantly improves them significant. significant influence them, right? Whenever XYZ takes some decisions about the operating or the finance or the investing activities, whenever they take the decisions, these parties, they control these decisions or they put significant influence over these decisions. So if that is the case, so we identify those parties and organization as related parties. And the other way around, so you can see as an entity XYZ Limited, they have control of this said limited company. Then there can be some of the parties or the organization under XYZ Limited, the parties. You put the control. You have put the control. You control it either way of control or put significant influence. Significant influence. It could be by way of direct or indirect. So by way of direct or indirect. Right? Both. So it comes from directly or indirectly. Now, in this particular scenario, so entire parties, organization up and above here who control and put the significant influence. So every parties we call it related parties. So this is like entire family, right? So if that is the case, now there is the inherent risk. I told you there are some of the items inherently there are risk. And this is one of the area we have a very significant risk because when you do the related party transaction, it's depend on the family people, right? Non-people. So when the transaction happen between the non-people, maybe the price of the transaction is not correct. Maybe the fair value of the property value assets are not correct. Maybe they haven't recorded this transaction in the financial statement, right? So there could be so many instances. So that's why we say whatever transaction happened between the related parties very risky. So the value of the transaction may be not recorded ID or they have recorded very less value, small value. And the meantime, identifying these parties is also very difficult. And let's say, for example, if you look at some of the organizations like Haley's PLC. Let's say Haley's PLC is another company. So this particular PLC company has so many subsidiaries, associates. So if that is the case, their structure is very difficult to understand, very complex. So how auditor can recognize all the related parties, very difficult. And even they recognize the related party, how do they recognize everything, completeness of the related party transaction? So everything need to be disclosed in the financial statement. So that is very difficult things to do. So that's why I say it's very difficult to audit also. And in the meantime, this particular item has inherent risk. So auditor need to be very vigilant when it comes to auditing related party, right? So audited parties, the related parties, the parties or the organization who put the control of the significant influence directly or indirectly over a company or in the below, above, and below the same parties control and significant influence directly and indirectly to the reporting entity are also including the related party. And in the meantime, the close family members also related parties, key management personnel also be considered as related parties, right? Now, what kind of audit procedures here auditor can perform? What kind of audit procedures? As I said, very risky area. So even auditor figure it out. Who are the all related parties, especially like very complex situation, very complex group structures. Now here, so to identify the related parties, what auditor can do? One thing, auditor can inquire from the management about the related parties, right? Inquire. He can inquire from the management. He can get the shareholder listing from the organization. Shareholder listing. So whenever you see the shareholder listing, you can see whether this particular major shareholders has some other connection from the other company. So you can take another one of audit procedure. You can see inquire from the management. Inquire from the management, or you can inquire from the previous auditors. You can talk to the previous auditor with the approval from the company. You can talk to the people, and in the second can inquire from previous auditor. In the meantime, you can check, review worksheets of the previous audit. Worksheet, what do you mean by worksheet? So they might have done some of the workings to check the related parties in last year. So if you are the same auditor from the last year, you can check the worksheets, whatever they have done previous year, and to see how they have recognized the related parties. In the meantime, you can obtaining or the review and reviewing shareholder listing, especially whenever somebody, when particular organization acquire another company or invest into another company, so those transactions you can ask from the management. You can check whether those transactions are available, and even if there are transactions, especially these transactions are discussed in the board meetings, right? So we can check the minute of the meeting, minutes of meetings, minutes of meetings of board of directors, and especially if there is a minute of audit committee meeting. So those are the special committees or the meetings that are happening in the organization. So if there are minutes, then you can go through them, especially right. So especially most of the major transactions are discussed in this board. So where when you go through the entire minutes, you can identify easily some of the major areas of the organization, right? So these are the tests you can do, and in addition to that, there are so many things you can do. In the meantime, you can ask for a written. You can talk to the. You can ask for a confirmation from obtaining confirmation from the lawyers also. If they know who are the related parties, then obtaining confirmation from lawyers. 7. Especially, you can ask management too, because we know that. So we as auditor is not in a position to identify all the related part transactions. So we can ask management to say, look here, management, you need to confirm all the related party transactions are disclosed to the auditor, and meantime properly disclosed in the financial statement. So we get a written confirmation from there because there's a high risk. So we can ask for a written confirmation. We call it written representation. Obtain written representation from the management. Now this one, Kuta, just remember that obtaining a written representation from the management doesn't conclusively enough. It's not 100% enough to cover this area, right? So obtaining a confirmation from the management to say that you just confirm us, so everything's done. It's not going to enough if you do it only this, right? You need to do other testing in line with this, right? So this is kind of a supporting evidence, not the conclusive evidence. It's just a supporting evidence to support the other evidence that you gather, right? So you can't just take a written representation to the management and just ignore the related part answer, auditing related part answer, right? So remember that. At the meantime, let's see the other one, event after reporting period. So you can do the same thing. It looks like the same set of things you can do, but let me write it down. Since we have written all these things, so we don't want to write it again. So let me explain what the context we are talking about here as event after reporting period. So what do you mean by event after reporting period? Event after reporting period. So this LKS thing, so it says, let's say for example, in this particular year, so our year end is 2024, 31st. So if that is the case, now in this particular standard, LKS 10 talks about event after reporting period. So now how you are going to do an audit for this particular item. Now event after reporting period is where, so until such time the company director approve, authorize financial statement. So until they authorize the financial statement, there could be some instances. Your year is here, starting from 2023, 1st of April. So there could be some instances of the event that are happened in the organization during this period, right? So, but if you look at the financial statements are prepared on this particular date, and we are just giving presenting to the shareholders maybe after so many months, right? So, if that is the case, accounting standard say here. Now, I know that you have prepared the financial based on the information available in 31st March 2024, but you need to check whatever the events that are happening in the organization subsequently until the directors authorize this financial statement. And then there are events you might have to adjust to the financial statement. And in the meantime, there are some events you don't need to adjust, but non-adjusting event. So we call it non-adjusting event, adjusting and non-adjusting event. So if that is the case, so what are the adjusting events? Now, let's say for example, one of our main data is rupees 100 million. Now, you might get to know this particular organization has background. This particular organization has background. You get to know this information by this particular period. Let's say one of a day. Let's get another day here. This year, let's say June 30th. And before that, you get to know about this information. So if that is the case, then recoverability of the data you have already tested at the year end. Recoverability of all of the data. But the event says that your testing is not good, right? So whatever you need to see whether you need to make a provision for this, right? Data provision for bad for debt, that time we call it provision for impairment test of trade receivable. Even though you have performed that test, but this information you have missed it. So now in the event, whatever the event that is happens to say that this by entity has background, so that gives an indication your estimation was wrong. So if that is the case, then that is called adjusting event. So event that proves that your estimation is incorrect, so that is called adjusting. So we need to adjust this to financial statement, right? And there could be some events that are happened in the organization subsequently to the year end, but before the directors authorize this financial statement, but that doesn't give an evidence to or say that your estimations is wrong. That is like something that is happened after the event, no connection between whatever the information is available as at 31st March, right? So those are we recognize as non-adjusting event. For example, there is a fire here or a flood here, so there's a property damage worth of rupees 5 million. So if that is the case, that's a non-adjusting event you need to disclose in the financial statement. So either thing you need to adjust or non-adjust it. So in here, how auditor is going to test this is a problem. Another significant area where auditor is not in a position to identify all of the event after reporting period unless organization themselves has disclosed how they are adjusting the financial statement, right? It's very difficult to audit, another area, difficult to audit area. So we call it highly risk area, inherent risk area, or we can say significant risk area, right? So how we are going to do the audit? Now, auditor is supposed to identify those events. Can they do? It's very difficult, as I say. So what are the procedures that he is supposed to do? What are the audit procedures? The same thing. Now he can check the minute of the meeting of the directors, minute of the meeting of the audit committee. They discuss these important matters there, right? So with that you can get more idea, right? That is one. The second thing is you can check whether is there any major investment after the year end in this particular period. Is there any major, you can inquire from the management, is there any major events that are happening in this particular period? Or else you can say, you can check with the subsequent financial statement. You can ask them to provide the subsequent financial statement. So when you go through that, you can identify if there are some events that are happening in the organization, right? At the meantime, you can ask them to provide the budget. They might have prepare a budget for the next year or the forecast. So you can ask for a budget on the forecast. When you see the forecast, there would be some of the events that are reflecting in the budget or the forecast. So those are the tests. So you can inquire from the management, you can inquire from the employees regarding these events, and you can inquire from the lawyers as well. You can inquire from the lawyers. Is there an event that has happened during this period? So inspecting minutes of the meeting, inquire from the unusual transactions, and you can check the investment activities that have happened after the reporting period. So those are the things you can do. At the meantime, so as I said, it's very difficult to audit. So then again, we can ask management to provide a written representation to say that all the event after reporting period, especially the adjusting event, they have adjusted in the financial statement, and the non-adjusting events, if that is material, so sufficiently disclosed in the financial statement, right? That is what accounting standard report. So that is what event after reporting period. And then shall we move to going concern event after. going concern. Now you know that going concern is something that the underlying assumptions we use to prepare financial statement, right? We used to prepare financial statement. Okay, let's move to going concern. Now we will touch upon this area. What is going concern? That's the underlying assumption we use to prepare the financial statement. So without this, we can't classify our assets into two categories, liability into two categories, no more current assets and non-current assets, especially non-current assets. So you can't classify as non-current assets. So based on these underlying assumptions only, we used to prepare the financial statements. Now auditor is supposed to check whether this assumption is still available, whether this particular organization doesn't have a going concern issue. That's need to be made sure by the auditor. So where that is the underlying assumption. So basically to use to prepare the financial statement. Now auditor needs to check whether is there any uncertainty regarding this going concern, right? So going concern, we call it GC, going concern. So there, what auditor need to check is there are set of indicators. So auditor need to check whether there are any indications. We call it financial indicators. Or as we call it operating indicators. Or other indicators. So auditor is supposed to check whether is there an indication about the financial ability or the operating ability or the other indicators which impacts to the organization going concern, right? So there, if you look at the financial indicators, so there are so many indicators. Let me say, for example, there could be a situation financially. You can see share capital, right? For example, let's say share capital is 100 million. Stated capital is 100 million. And if you look at the retained earning, RE, so that is a loss, 120 million loss. Now this says we have a negative equity. So there it says there's negativity of 20 million. That's one of the indication. Basically, it says owner has invested to the organization to make it profit. But now what has happened? The company has made a loss. Now even the owner investment value has come down to zero and invert to the negative. So this is one of the indication where company is heading to another problem of a going concern, right? And the second thing you can see financial indicators. So you can see even if you look at the financial, so we call it cash flow statement. If you see the operating activity, if that is negative consistently for previous years, then there's a serious issue because your operation doesn't generate cash to the business. So it says outflow to the business. That's another major issue. You can identify they might have an going concern, right? And there could be some situation where bank loan they haven't repaid, even though they are obliged to do that, they haven't paid the bank, and bank has charged penalties because they have not done their bank payments, right? Bank loan repayments, and creditors basically they have stopped providing goods to the organization. So those are the few indicators you can identify this particular organization is heading to another problem of going concern. So if you see those indications, then you can immediately you need to assess whether this particular organization still are they do they have a problem of a going concern, or can they prepare this financial statement based on going concern basis, right? So those are financial indicators. There are so many financial indicators we can identify, and see even in the study pack also there are set of so much of things they have given. For example, so those are the basically example we can say. And if you look at the operating indicators, maybe they have stopped one of a product, so they have maybe they have stopped doing an operation, they have sold another company, they have sold another, let's say for example, they might have 4 garment factories, they have sold one because it's making losses, right? Making losses. So that may be one of an indicator where you can identify they are heading to another problem because there are few operations. Okay, and let's say for example, another example, they might solve another business segment, or there are few instances where they can't obtain the raw materials, and they don't have money to import the goods, and they are not in a position to attract the laborers to the organization. So those are the operating indicators. Yeah, you can see, and there are a lot of machinery breakdowns because they haven't repaired them properly. So those are the indicators that we can see. Now there are problems in the organization where could be lead to a going concern issue. And so in the other indicators also you can say it's not. Let's say for example, you need to insurance the entire company for fire. So but they haven't done an insurance just to avoid the cost. So they haven't done any fire insurance. So that's one of the indicators. And even they have done the insurance, they have undervalued the assets to reduce the insurance pay premium, which need to be paid to the insurance company. And some of the laws and regulations they are not following, and so that's another indicator where they are going to fail in terms of going concern. So when you see those indicators in the organization, so you are supposed to assess whether is there any uncertainty in this particular organization. So even though they prepared their financial based on the going concern basis, whether still it is valid. So if that is the case, auditor need to determine whether auditor need to give an importance of in their audit report by giving an, we call it emphasis of matter. Audit report in addition to this audit report, in the audit report, auditor can do something like this. Auditor can give preference, priority to this emphasis of by emphasizing a matter in the audited report and saying to the shareholders, so look here, shareholder, you need to go through this thing. There's an uncertainty between about the organization. So you can just give a sentence in their auditor report. So that is called emphasis of matter, emphasizing this matter, right? So whenever there's an going concern issue, so when there's an issue, organization need to disclose this matter in their financial statement. So even if they have disclosed properly, then auditor can decide whether they need to mention an emphasis matter in the audit report, right? Okay, with that we can basically in the organization you are supposed to especially go through and identify. In the exam also there can be some scenarios, there can be some questions describing all these matters, and they might ask you to assess whether they have going concern problem. So this is going concern. And the last we call it, I have already touched and discussed, written representation is where you can ask from the management. It's like this. Now, when some of the obligation, some of the things management of the organization need to do, so you can mention everything in this particular letter and ask management to sign and give it to you. So that is basically to get a confirmation from the management to say that everything which need to be done from their end has been completed. Right? Let's say, for example, all the going concern basis is assessed properly and it's correct. That is also we can get a representation. And in the meantime, all the events of reporting periods are disclosed in the financial statement. And in the meantime, inform to the auditors as well. All the related parties transactions has been identified by the management and properly disclosed. And these things we can include in the financial, especially, I would say that is a letter obtaining from the management by writing, confirming that whatever the responsibilities of the management have been done. So that's called written representation. So in the meantime, so this provides some of the occasions as a supportive evidence. Written representation provided as a supportive evidence, so which can be used as the supportive evidence together with the other evidences, especially like this when you are doing an audit of this particular area, right? Okay, so with that we can conclude this session. Hope you can understood everything. And let's move to another past paper, latest past paper, and then discuss the matter. And we can then wind up the session. So let's move to the latest past paper, July 2024. And if you look at the past paper, and in the section C, question number 9, right? Question number 9. Let's go through the question number 9. So before we get into the question, so it's kind of a case. It has been this kind of scenario they have given. So, but before we get into the question, so let's see what are the questions specifically they have asked. Assess the reliability of following audit evidences stated in the above scenario. Okay. So one is receiving a direct confirmation of the loan from the bank. One more thing, Buddha, before we get into this, let me tell you something. Now, since we have already covered the audit evidence entire chapter, so I want to tell you something. Now, reliability of the audit evidence is, there are a few instances we relied upon more the audit evidences in the following scenarios. So more reliability is, we believe more. Situation where audit evidence are more reliable. So the first one is, we can say, so written evidence are more reliable than verbal communication. You can write it down. Written evidence are more reliable, right? Written evidences are more reliable. Second, you can say than verbal evidences. So if you take evidences from an organization where they have very poor internal control system, so those are not reliable audit evidences. But if you gather audit evidences from organization where they have a very strong internal control system, so those evidence are more reliable than the previous one, right? Evidences gathering from strong internal control systems. In short, so this is more reliable. Right? Third, external evidences are more reliable than those which are gathering from internal source. Right? Fourth one. So any evidence gathering by auditors directly are more reliable than which are received from the other parties. And original documents are more reliable than the photocopies. Original documents are more reliable than photocopies. So please remember these because it's a very specific questions share we tested so many times in the exam. Even the question that we are going to discuss, it's basically toward this, right? In evidences and verbal evidences gathering from strong control system, external evidences. Yeah, okay. Okay, let's read. Receiving a direct confirmation from the loan from the bank. Obtaining management representation as the audit evidence for considering a special fees as a capital expenditure. Oral communication of a security officer. Now we need to assess whether it's a reliable audit evidence. So I think you can answer very easily and score this 6 mark. And the second question they ask, discuss the appropriateness of the loan confirmation procedure in gathering the audit evidence on borrowing. So you can say it's very highly reliable information. That's what you need to say. So anyway, it's coming from external parties. If it comes directly to the auditor, then it's a reliable information, reliable audit evidence. Assess the impact of the special fee on the audit opinion and explain two circumstances where auditor may consider to include the emphasis of matter. Emphasis of matter to the audit report. Identify events and conditions that may cast doubt about the going concern of the endowment. Let's see the entire scenario. New World PLC NW own operates luxury shopping malls in situation in Colombo too. The audit for the year ended 31st March 2024 is in progress. A large sum of a bank loan has been obtained by the company. Construction of mall by mortgaging the land and the mall construction. So large amount of bank loan mortgaging what? Mortgaging the land of the business. That's one of the risk area. Let's move and see. Due to the economic condition in the country, NW has incurred operating losses during the audit and previous year. There are continuous audit losses. So there's a indication, financial indication, whether they are in a position to continue the business. There's a financial indicator. There's a risk. As a result, 6-month loan installment of NW are in arrears. Oh my God, another financial indication. So you can say in the last question, right? You can answer to the last question. During the audit, loan verification has been assigned to Ranga, who is a junior team member of the audit team. Correspondence with the bank shows that NW violated loan covenants. Loan covenant means the sense loan conditions. And the bank has sent a letter of demand as the first step to legal actions to recover the bank loan by acquiring the land and building. Oh my God. Now bank is going to acquire their building. So that's another indicators, right? Those are the indicators. So now the company is heading to a going concern issue. Loan covenant required NW to maintain certain financial ratios. So when we get the loan, bank, they have given us a condition to make sure that certain financial ratios need to be maintained, especially like debt equity ratio. However, the management has not taken any action in this regard. So that's another indication. Basically, that's another indication where company is headed to a problem. You can say the agreement, loan covenants, loan conditions are not met by the NW. And this has not been communicated to the auditor. Oh my, this has not been communicated to the auditor. Ranga has requested NW to call the direct confirmation balance outstanding from the loan. So Ranga has requested NW organization to send the confirmation. That's not the case. Auditor himself need to send the confirmation to the bank, not through NW. Other than this, Ranga didn't follow any other audit procedure to obtain the audit evidence. That's not good, right? So that's not a reliable confirmation even if he received. Materiality of 3.4 million. Now we were talking about the material risk of material misstatement. Material risk. Always I have emphasized this word material. So material is something that auditor need to decide before we start the audit. So that is where now materiality is very important, because materiality level is something that we believe when somebody takes the decision over the organization, if some information is missing or some information is misrepresented, and if that material, if that value of these transactions goes beyond this material level, then whatever the decision they take is be a wrong one, right? So materiality is important because so that is the criteria, that's the value we decide. Whatever the parties who take the decision over the organization, those decisions could go wrong if the informations are not properly presented. So now they have decided the material level is 3.4 million. And based on profit, NW has imported high-tech generator during the year to provide the power during the power cuts. And 5 million has been capitalized as a special fee. Oh my God, what's the special fee? Special to get permission to import a generator due to the current import restriction. There are current import restrictions are available, but still they have paid some amount of cash to someone to bring down this generator, right? So that's the good money somebody has taken. So there is no written evidence, I guess. However, NW is unable to provide supporting documents to justify this transaction amount that can be capitalized as an asset, except the checks payment appearing in the bank statement. So we can see the check money has gone from the bank. So except for this, we don't have anything to prove this transaction. So this is material, right? If the material level goes up and we don't have a supporting document, then we need to give an modified opinion to the financial statement. So we can't just give a true and fair view. We can say this is material and no supporting documents are available. So we can justify and give a modified opinion, highly qualified opinion. Or if this is material, yes, more probably if this particular item only we have a problem, then we can say other than this, the others are true and fair view. Therefore, auditors suggested that this amount should be considered as an expense. Yes, of course. Unless otherwise, we don't have any documents. It should have been considered as an expense. If not, this is material statement. However, NW didn't agree with the adjustment and agreed to provide management representation that special fee is a capital expense. Now, they are going to say provide a management representation in the letter saying, so this is considered as a capital expenses. That's not a good one. During the physical verification of property, plant and equipment, it was observed that 5 air-conditioned machines were not physically available. My God. So those are not available in the organization. Security officer of the premises has orally communicated that the machines were taken for the regular service by a third party who has contacted for maintenance contract. So those are basically they have given for a maintenance. Further, 2 key management persons resigned recently from the company, and those positions have not been filled yet. Another indicator. So especially those who are in the management level, they get to know about the business situation. Especially like if the business is going for a going concern matter, they get to know. So if that is the case, they might leave the organization and without unfilled for so many months. So that's another indication. You can write down everything. There are so many things under this 5, right? So let's take one by one. So assess reliability of the following audit evidence. So one is receiving a direct confirmation from the bank. So receiving a direct confirmation from the bank to the auditor is a reliable information. But in this particular scenario, you need to write it down. Write down saying this particular scenario, auditor has asked NW to send the bank confirmation to the bank, and that is not the reliable confirmation, even if they received, even if the auditor received it, because what is reliable is if auditor directly calls the confirmation from the bank, that is more reliable than the confirmation received through NW. So that's what you need to say. That's it. Second one, obtaining management representation as the audit evidence for considering the special fee as a capital expenditure. So I clearly told you, obtaining just a management representation is not a conclusive audit evidence. You need to gather some more audit evidence. Management representation is just a supporting audit evidence. So you need to use coupled with the other audit evidences, right? So that's what you need to tell here. Obtaining a management representation does not justify the this transaction itself. So auditor need to gather some more audit evidence, and written representation we can only use as a supportive document, supportive audit evidence together with the other audit evidence. So you can say like that, right? So the other one, oral confirmation from the security office. So as I said, oral written evidence are not when compared to the written evidences, oral confirmation, oral audit evidence are not reliable. So it's better to take a written evidence from the security officers. You can say like that. That's it. Discuss the appropriateness of the loan confirmation procedure in gathering the audit evidences on borrowing. You can discuss. When you say discuss, you have to just write it down saying, so this is why, this is how, just you need to explain it properly, right? Discuss. Appropriateness of the loan confirmation. So now you need to say again. So auditor is supposed to get a loan confirmation from the bank. If auditor directly call this confirmation from the bank and to respond to the auditor directly, so that's a reliable audit evidence. But in this case, auditor has asked NW to send the bank confirmation to the bank. So auditor is going to receive this particular bank confirmation through the NW. So that is not a reliable audit evidence. So this should have been taken directly by the auditor from the bank. So that is considered as a reliable evidence. That's what you need to explain. Assess the impact of the capital fee on the audit opinion. So now we need to assess. Assess in the sense you can say how we are going to give the opinion. Now in this case, special fee, whatever the special fee they have paid to the customer, or I don't know to whom they have paid, but in order to bring down the generator to the organization, so it doesn't have supporting document, enough supporting document. At the meantime, the value of this particular transaction is above the material level. So we need to consider this particular matter. And auditor basically, I have asked to charge this amount to the P&L as an expense, but whereas they have just given a written representation to say that. So this should be included in the capital expenditure where we can't accept it. So it exceeds the material level. So auditor need to see and just issue a modified opinion. And further you can say if this particular, if end of the audit, if they found that in this particular transaction only has a problem, so if that is the case, they can issue the qualified opinion. Or if that is spread to everywhere, I mean, there are so many misstatements, if auditor has found it, including this, if that is the case, he can issue an adverse opinion as well. So that's what you need to explain here. Anyway, you can have to say you need to, as auditor, they need to modify their opinion accordingly because this particular transaction level is above the material level. Explain two circumstances where auditor may consider to include the emphasis of matter paragraph in the auditor report. So why we need to give an emphasis of matter paragraph? Just to attract the what you call shareholders' attention immediately to the auditor report. So they can say, especially like when there's a going concern issue, so auditor can include the emphasis of matter in the financial statement, so auditor report. So that's one of circumstances where he put an emphasis of matter. You can say when there is a going concern issue, so auditor can include that uncertainty. Auditor can include emphasis of matter paragraph to the auditor report describing the uncertainty. And the second scenario, we can give emphasis of matter. Let's say, for example, now anything else, if emphasis of matter we include in the audit report in a situation where if auditor wants to attract or get the readers, I mean shareholders' attention to any particular item, which is properly described in the financial statement, right? That item should have been described in the financial statement, and auditor needs to mention the page and the note number, everything there, right? So anything that is, let's say for example, there's a contingent liability. if auditor think that shareholder should read this particular item especially, then he can put an emphasis on that. Let's say for another example, when auditor wants to give emphasis to one contingent liability, material contingent liability, which is disclosed in the financial statement, so he can include the emphasis of matter. And the third scenario, we can say, let's say for example, there are few occasions where companies do the early adoption of the accounting standard. So if that is the case, early adoption in the sense, maybe chartered institute or they make it compulsory for some of the organization to do their adoption on a particular day. But if some of the organization, they might early adopt it. If that is the case, we can describe then the entity emphasis of matter paragraph. Okay, and hopefully you can write down the last one. And easily, there are so many items, indicators, you can write it down. And with that, Putha, now we can hopefully we can conclude the sessions. And I wish you all the very best for your upcoming exam. And hope this session would help you to get more marks in the audit evidence chapter. And thanks for AAT Institute for organizing this event, especially and improve the awareness among the AAT student as a professional organization. Thank you very much.